Super Microcomputer Inc., trading under the ticker symbol SMCI on the Nasdaq, is currently priced at $33.81 per share in today's regular trading session on Friday, May 22, 2026, marking an intraday upward movement of 1.05% from its previous close. While a simple 1% daily gain might look like background noise for a typical technology stock, it tells a very different story when you look closely at what is actually happening behind the scenes. Right now, major institutional desks are executing stealth accumulation patterns, slowly building up exposure to clear out localized short positions before the broader market picks up on the trend. This subtle upward trend is creating a quiet foundation that completely catches most retail investors off guard, especially those who only track high-profile equity names on the standard financial news networks. When you scan mainstream investment forums or look across major online investing platforms, the dominant narrative surrounding this asset is heavily weighed down by caution and outright skepticism. Most market participants look at this asset through a lens of fear, assuming that the explosive valuation peaks from previous market cycles are gone for good, and that corporate governance issues have permanently broken its fundamental trajectory. This general belief creates a massive psychological barrier for the average person engaging in self-investing. The prevailing sentiment tells you to stay far away, citing legal overhangs, shifting market dynamics, and extreme historical volatility as reasons to avoid the company entirely. However, looking beneath that surface level of fear reveals a completely different reality. The market is currently making a major miscalculation by treating this company as if it were a distressed legacy business, rather than recognizing it as a highly agile liquid cooling computing specialist with incredibly deep ties to large technology suppliers. While the crowd focuses intently on past legal headlines and minor quarterly revenue misses, a massive fundamental shift is quietly taking place in product margins. The company recently posted an adjusted gross margin surge of 370 basis points, jumping to 10.1% from a previously thin 6.4%. This massive leap in profitability proves that their pricing power is returning and that their high-margin computing solutions are gaining serious structural traction. The expectation was a prolonged margin collapse, but the reality is a swift financial recovery. This dramatic tension between what the public expects and what the financial reports actually show is triggering a major reallocation of capital across top-tier individual brokerage accounts and institutional funds. Traders utilizing specialized accounts at Interactive Brokers are noticing a steady rise in daily trading volumes, with tens of millions of shares changing hands as large players quietly build positions. This isn't the reckless retail speculative volume of the past. Instead, it represents calculated programmatic accumulation by systematic wealth managers who recognize that the underlying cash flow dynamics are beginning to turn positive. Sector momentum is starting to rotate back toward high-performance enterprise infrastructure, providing a strong macroeconomic tailwind that helps insulate the stock from broader index pressures. If you look across the popular investing sites or check your personal portfolios on the Robinhood app, you can easily see how this asset compares to other heavily traded tech options like Tesla stock, Apple stock, or Nvidia stock. Unlike those massive mega-cap names that trade at sky-high valuation multiples, this specific business is currently trading at a highly compressed forward price-to-earnings ratio of just 10.5 times. This deep discount places its current market value nearly 60% below its historical intrinsic valuation assessments. This creates a massive anomaly, where the underlying business growth is accelerating while the stock price is valued like a slow-moving cyclical manufacturer. This stark divergence is exactly why automated services like Schwab Intelligent Portfolios and other algorithmic online investment tools are quietly adjusting their tech sector weightings behind the scenes. For anyone looking for professional investment help, the data shows that institutional asset allocation is moving toward under-the-radar tech firms that offer strong fundamentals without the premium price tag. Large capital managers at Fidelity Investments are consistently adding shares across diversified portfolios, marking capital in various Fidelity ETFs, Fidelity mutual funds, and premium Fidelity brokerage accounts to capture this deep value opportunity. This institutional backing provides a sturdy floor for the asset, keeping it stable even during periods of broader market volatility. To understand why this mispricing exists, it helps to look at the exact mechanics of their business model and corporate operations. The firm functions primarily as a modular architecture specialist for high-performance server systems, utilizing a comprehensive building block approach to build custom data centers. Instead of designing individual semiconductors, they purchase high-end chips directly from major manufacturers and assemble them into highly optimized liquid-cooled server racks that handle massive computational workloads. This unique setup allows them to rapidly scale up production and deploy custom hardware much faster than traditional legacy infrastructure competitors, giving them a significant
significant operational advantage when large enterprises need to build out vast data centers on tight timelines. Recent tracking on the popular SoFi trading platform shows a significant increase in accumulation from retail accounts focused on self-investing. Long-term investors utilizing a SoFi active investing strategy are increasingly treating recent pullbacks as prime buying opportunities, using tools like Robinhood fractional shares to build up their stakes over time without taking on excessive capital risk. This steady baseline of retail support is creating an interesting technical floor, as every minor dip below key moving averages is being met with swift buying pressure from both institutional algorithms and retail investors looking to maximize their long-term returns. Comment below how many shares of Super Microcomputer Inc. you currently hold in your portfolio right now. Hearing how different investors are sizing their positions provides great insight into how retail sentiment is shifting relative to institutional money. When you look at the macro picture through the lens of institutional platforms like Interactive Brokers Trading or advanced portfolio metrics on a Fidelity Wealth Management dashboard, it becomes clear that the long-term outlook hinges entirely on how effectively the company can scale its specialized data center building block solutions. Management has set an ambitious internal target to expand these highly efficient liquid-cooled offerings to comprise over 20% of their total net income over the coming years. Because these custom setups carry much higher profit margins than standard off-the-shelf server configurations, hitting this milestone would structurally elevate the company's long-term profitability profile, permanently shifting the business away from low-margin hardware assembly. Looking forward, the future path for this asset is shaped by a handful of distinct potential outcomes. In the highly optimistic bull case, customer concentration risks begin to fade as a wider variety of enterprise clients adopt their liquid cooling technology, allowing the business to easily hit its multi-billion-dollar annual revenue targets while maintaining healthy double-digit margins. Under this scenario, the cloud of legal uncertainty lifts completely, forcing major research desks to upgrade their ratings and driving the stock price back toward its historical valuation multiples. Conversely, the more cautious bear case warns that persistent component shortages or an unexpected slowdown in global data center expansion could limit near-term revenue growth, while ongoing regulatory scrutiny could keep a lid on valuation expansion for several quarters. When you evaluate the totality of the data, the central takeaway is that the market is currently pricing this asset based on outdated fears and backward-looking narratives, completely missing the structural turnaround occurring right now. The public expectation is focused heavily on past corporate drama and short-term earnings volatility, while the underlying reality shows a business that is successfully expanding its profit margins, locking in institutional support, and trading at a steep discount relative to its long-term cash generation potential. This classic mismatch between public perception and fundamental reality is exactly what creates compelling opportunities for disciplined long-term investors. Whether you manage your assets through automated services like a SoFi robo-advisor, execute active trades via the Fidelity mobile app, or run a hands-on strategy on the Interactive Brokers platform, keeping a close eye on this fundamental divergence is absolutely essential as the broader technology landscape continues to mature. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.